everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is Long Verticals and Diagonals. And today, I have a pretty simple objective. I want to talk about the importance of the long-term perspective when planning short-term trades. I think that some of us out there can relate to getting a little bit too focused on what's happening on the very short term and missing something that may have been vital to the ultimate success or failure of the trade that was happening on that longer term perspective. So we're going to be giving that a little bit of a focus today. We're going to be planning and placing a new trade, a lot to get accomplished. But before we can do any of that, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see my live audience members. Hello there, High Speed, Low Drag, Selva, Life in the Fast Lane, Will, Amy, Bob, Mary, Randy, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in a live discussion if you'd like to be here. This is a Thursday webcast series that kicks off promptly 11 Eastern time. We would love to have you here in the live stream audience if you'd like to join us. I also want to let our live stream audience members know that Connie Hill is going to be hanging out in the chats with you. Connie's a fabulous coach. She brings a wealth of knowledge and experience to this discussion. Connie's just going to be answering any questions that I can't get to just during the flow of the presentation. As long as they're on topic, Connie's there to help pick up the slack for me. So thanks for being there, Connie. And Connie and I would like to issue an invitation to everybody watching. If you have an account with X or on that X platform, give us a follow. It's the very best place to connect with your favorite presenters in between the live streams. And you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. Just give us a quick follow. It doesn't cost anything to do that. But I'll look for you there in between these live streams. But let's get into this. And as we do, of course, the first thing that we need to do is consider the risks associated with investing and with trading. Certainly applies to options trading. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So let's set the agenda for what we're going to be accomplishing today. So I've already mentioned really what we want to highlight today, but in this webcast series, the first thing that we always do is take a look at our existing paper money positions, our example trades, and just see if any of those need some attention. I think there's one that we might be doing something with today, but 6 positions that we're going to be reviewing, and then we're going to get to what's happening with the stock market. And I want to take a look at what's happening with the S&P. I'm going to be soliciting your input on what you're seeing happening on the chart. And then I'm going to have a little bit to offer as well. And then we're going to use that as the backdrop for planning and placing a new trade in our example paper money portfolio. So manage existing positions, take a look at the markets, and place a new trade. That's going to be the agenda. So let's go right to Thinkorswim desktop. And we're going to start things off with Apple. Let's go see what this is. On our monitor tab, we can see these are my positions for other series that I have going on right now. But for right now, we have long verticals and diagonals. So we're going to start at the top, work our way to the bottom of the existing positions. We have Apple. What's going on with Apple? Well, Apple is a long call diagonal where we bought a 235 call. And right now, we also have a short 240 call against that position. So we have a bias for price to be going up, but to stay below 240. And actually, as of this moment, that's what Apple has been doing, at least since the last time we convened. But there's a longer history to this trade than just that. So if we roll the clock back to when we started this position, this goes all the way back to, what was that, March 6th. We bought our 235 long call. And at that time, we also entered into a 250 short call. And that created a net bullish position. Well, the stock didn't behave bullishly. Straight out of the gates, we started to fall. That doesn't do a great service to the long call, but to our short call, it allowed us to exit almost right away. The very next week, we closed out with a $292 profit. And then we find ourselves, after that drop, we noted, you know what, we came down to a previous level of support. Let's see if that holds. If it doesn't, we're just going to close out of that long call. But in the meantime, we sold a new short call position up here at 240. And that one's still in place. And since then, you can see price has been in recovery mode. That's good for this position. Our long call is now in recovery. We're still solidly below that 240 short call position. That thing expires on the 18th of April. We'll let this one continue to work, okay? But let's go back to our portfolio, and I want to look at GILD. With GILD, we actually closed out of a short call just last week, leaving us with just a long. So this is a 17th of June, 2027 call. So 812 days on this. This was part of a diagonal spread. Now it's just a long call. But let's go have a look at what's happening with GILD. So with this position, we entered the trade back here on January 30th, and the stock started rocketing up, which was really good for this long call. It was making a lot of money, but along the way we had sold some short calls that we had to close out at losses in order to allow that long call to continue to run. And we rolled that up once, we rolled up twice, resulting ultimately in a short call position up here at the 120 strike. And as we pulled back from that, we were able to close this last short call, close that out for a profit. And last week we decided not to sell another short call because it looked like we might be starting into a nice run up. On the evidence, now not everybody's going to see this the same way, but we ran up so far so quickly that for some traders they may use a Fibonacci to measure the proportions of that run up. And in this case, we noted that we had pulled back and come back down about 50%, almost exactly 50% of this run up. And that's kind of typical anticipated proportions. When we have a strong run up, some traders expect about a 50% retracement. Doesn't always happen, obviously, but in this case it did. And so we decided, let's let this one run for a little while, just own the long call. That's, up to this point, proven to be the right thing to do. But I think what we'll do now, if we look at just today, we've run up, getting a little bit of a long, and now obviously a day's not over. We're just in the early hours of trading right now. But we have kind of a tall wick sticking out of the top of today's candle. And what that may signal is that maybe price is set to pull back again a little bit. It's not always going to do that because if you look at yesterday's candle, it looks similar. But I think what we'll do here, let's look to see if we could sell a new call, a short option. It might be up here with the 115. Let's go see what's available. Let's go to our trade tab. We're going to make sure that we're on GILD. Let's maybe for this one stick a little bit shorter term. I'm going to go to this monthly expiration for April. We already have a number of positions expiring for that expiration. On our second new trade today, we're going to actually move a little bit further out. But for this one, for our short option, let's go for this 17th of April again, and let's see what is available out here. Oh yeah, we have a good number of choices. We have dollar increments, so we could sell at 115, 116, 117. 115 is going to be a little bit north, probably, of a 1% premium on the value of the stock. And for some traders, they may use that as a bit of a gauge. Also, for those that look at to delta as a probability, there's about a 29% probability of this expiring in the money, a 29% probability of, or pardon me, 71% probability of this expiring out of the money. Now, as I call attention to delta, delta can also be used to gauge the leverage of a position. We know that it can tell us how much we can make or lose on a $1 stock in unrealized gains or losses, a $1 move in the stock. But let's just look at that as, how about we sell this 71% probability short call for, looks like somewhere between $1.20 and $1.30. So we're going to be making this back into a diagonal. So let me go back here to our chart. I'm going to draw that in again. Let's see, that's going to be up here at 115. And that's going to be just below these previous highs. Let me draw that right here. I'll start it just above today's candle. And we're going to carry that out to expiration right about 115. And I'll make that red just so we know that's a short position that we're taking there. There we go. Just gives us a visual reference point. So we definitely have a preference here for price to continue to climb, helping out that long call that we're still in. But what we'd like to see is on the 18th of April, preferably we're below that 115 level. And maybe this resistance might help us with that. And by the way, let's get that longer term perspective there. Let's see if there's any other confirming, and it doesn't look like it in this case. The longer term provided some additional evidence here, provided some additional technical evidence down here. But in this case, we're up trading near all-time highs, so we don't have anything to confirm longer term. Well, unless we go even further out. Oh, what do you know? There we go. That's the importance of the longer term perspective. It looks like, yeah, the stock actually has struggled up at around these levels. So let's go back to that 1-year chart. Let's go sell that 115 call and see how much we can get for that. I'm going to click on the bid price. I believe, let's double check here. Yep, we have 3 contracts. So I'm going to sell 3 additional contracts at that short strike. Let's do that 1, 2, 3. And the natural being at 126, the mid is at 127. You know what? I'm going to say we're okay even with a 126 credit here. That we're still entering that as a limit, so there's not a guarantee this will fill, but let's see if we can get a fill. We're going to click confirm and send. Selling 3 of the 17th of April 115 calls, trying for $1.26. That would give us $378 minus $1.95 in commissions. So a net of $376 that this short option might be contributing here. Let's see. Okay, we sold it at $1.28, a little bit better. So we're in a diagonal spread here. We'll see if the stock can start to rise further. When you put on a new position, notice we've arranged these into groups. Pardon me. We've arranged our positions into groups for my different YouTube series. This one's called Long Verticals and Diagonals. The new position that we just sold is still down here. We haven't allocated it to a specific group. So let's right click. Let's move that to our Long Verticals and Diagonals group. So now it's up there paired up with the long call that we already had. So let's now look at our JP Morgan position. In this case, we bought a 260 call, sold a 265 call. We have a preference for price to rise. This one was uncooperative. Let's go see what's going on here. See if there's anything that needs to be done. Here's when we took this trade. What we'd like to do is be up here above our 265. That would put us in our maximum gain territory. Well, we went up there initially, but then started to fade, and we faded hard. Came all the way down. We reassessed looking at a possible previous resistance, just like what we saw earlier, maybe new support. And we've had a really sharp V-shaped rally here. A technical trader, though, might be a little bit concerned that we're bumping our heads against this same level that we've seen before and starting to pull back. So what do we think? We still have through the 18th of April. These contracts are out of the money, unlikely to see assignment on our short option, could still happen. But if we can get if we get one more burst like we had before, we could be up in max gain territory. Let's go see how much damage has been done. So when we originally took this trade, this was a relatively aggressive out of the money position. So we spent about $2.60 on a $5 wide spread, leaving $2.40 that could be made, but $2.60 was how much we could lose per contract, $260 per contract. We had 7 contracts. Let's see, let me get my calculator out here. 260 times 7 is $1,820 that could be lost here. Right now, we have an unrealized loss of a little bit over 1,000. We're just shy of 1,100. So we haven't taken full damage here, but it's stinging. It was worse 2 weeks ago. It was much worse when we were down here. So is this now a window of opportunity to maybe cut our losses? Or should we stick with it and see if we can recover entirely and maybe even flip this trade into a max gain. Well, oh, Wiley says, hey, let's fib this downward move. Okay, Wiley, let's do that. Let's come over here. Let's click on our fib retracements, our Fibonacci retracements tool. And typically, when we see a strong move to the downside, the trader will go to the bottom and click once to start drawing their fib, and then move to the top and click again. Oh, look at this, Wiley. Yep, strong move down. Where did that recovery start to struggle? Right at about that 50% level. We actually closed trading below that 50%. Yeah. So how about with this position? Let's ease off the throttle. How about we stop the bleeding on 3 or 4 contracts? I'm going to do that. Let's right click here. Let's create a closing order and choose to sell. It's going to choose all 7 by default, but let's close out of 3 of these. 4 of these. Yeah, let's do 4. All right. We're going to see if we can pull $1.04 credit. You know, the natural's a 96. I'm going to say even if we can get out for $1. Let's say that we're okay for that. So if we get out now, we spent $2.60 on those verticals. If we can only get $1 out of those, that leaves $1.60 of realized loss. But it also means no additional risk on those contracts. So there are pros and cons to each decision we're making here. But let's click confirm and send. We're going to sell these verticals, trying to get $1 out of them. We don't care about max profit, max loss on these because it's a closing transaction. There is a commission to be paid, which is going to reduce the potential credit a little bit. But let's send this off and see if we can get out. And there we are, out at 103. So let's make a quick note on our chart. We'll put it right on today. Make a text note right here. Closed 4 verts for 160 loss. Right there. Maybe I'll throw an oval around that so we can see which day that happened. We can't see it because it's hidden behind our box. That's okay. Anyway, so we're out of that. Maybe what I could do here, let's just activate this drawing and push it right over there so it's pointing right at it. And we'll make it red just to emphasize that that was not a profitable exit. However, we have stemmed the bleeding on those. Now, if we get a reversal here, the other 3 still have the potential to turn from $1.60 loss into $1. What do we have left over? $2.40 gain? That's a possibility. It's unlikely, though, because we need to get all the way up here before that April expiration, but we'll see. All right, so Lowe's. What's going on with Lowe's? In this one, we have a long put vertical. Bought the 240s, sold the 230s. We prefer to be below 230. Right now we're at 233. It's sort of where we need it to be headed, but here's what actually has been happening with this trade. Took our trade right here, thinking that it was going to hold below this previous support level. And actually, we've crept up above that support level. Now, notice I have a box drawn here that shows us our break-even point. Right at this moment, we're right at break-even. So if we were to get all the way to expiration, if we were in the same spot, this trade would be sort of a break-even trade. But we're going to have to keep an eye on this. What we prefer here is maybe we can get a bump against this downward sloping trend. Let's see if we can get a bump and continue down. So I'm not going to be taking any action on this position, but it does highlight a point that I've made a number of times in the past, and that is when we take these higher probability trades, over the course of that, over the time frame of the trade, most trades at some point at least will look like they were a bad idea. And so the trader probably needs to prepare themselves for that psychologically. Sometimes the trade just cooperates from day one and it just goes right just like we would hope. But the probabilities actually demonstrate that even a high probability trade will look like a bad idea at some point as the stock is moving around on its way trying to get to expiration. So Shefali says, how do you draw these boxes? Just one of the drawing tools right down here. We just click on the active drawing tool icon just to the left of where it says drawing set. And we just choose the rectangle. And then it's a click once to start drawing and then a click again to end the drawing. And I've changed the color scheme on mine. You can right click on one that's already been drawn and edit its properties, change the color right there. Okay, so I'm going to remove that drawing. We're going to leave that one alone and go on to NVIDIA, which was last week's trade, I believe. Yep, if I click on this, it tells me, yeah, this was done on March 20th, that's last week. And this is a long put vertical as well. This one's much more cooperative. I think we're about halfway to max gain on this one. So probably nothing we need to do at the moment. Yep, here we go. Looks like we had, speaking of fibs, we had seen a strong sell-off, a 50% recovery, and then we took a bearish entry right here. And after a little bit of a wiggle up, this has been moving down again. A little bit of recovery happening today. We'll see where it decides to head from here. But we had a plan to consider exiting if we got back up above that 50 fib, but particularly if we got up above this 62. And we're not there yet. Matter of fact, since we drew it from the bottom up, that's actually the 38. That's okay. But in any case, we're just going to leave this one to work. And then finally, we have UNH. This has been an interesting trade. This is the one we kicked the year off with. We decided, let's do a diagonal spread all year long. What would happen if a trader just took on a trade and they stuck with it, managed it to the best of their abilities for the year, but we're just going to let this one go and make adjustments along the way. So we bought a 520 call, which is bullish, and UNH has been primarily not bullish. So our call here is actually about $10 underwater, about $11 underwater. Let's go have a look at what's been going on with UNH. So here's where we took that long call. We saw a trend line that we just pulled down to and bounced off from that, entered the long call, and started selling short calls against that position. Well, since that entry, the stock went sideways and then it came down. That allows us to close out this first short call for an $860 profit, a second short call for a $672 profit, a third short call for, what was that, $370 profit? So total, about $1,900 have been realized as gains on the short positions. Then we got this strong drop here. We entered into another short call at the 530 level, but look at this rally. That's been a great run. These last 6 weeks have been very good for this long call. It's really actually dug it out of a pretty significant hole. So now it's only about 11 bucks underwater, but these short positions really helped out in the meantime. So for here, we'd like to see this maybe go up a little bit further, hopefully stay below 530 as we hit that April expiration. But that one's a nice recovery mode story. We'll see if that can continue. John says NVIDIA was a bullish vertical. No, it was a bearish vertical. That was a long put vertical. We don't do any short options or short vertical spreads in this, John. So when you see put, that's going to be bearish. When you see call, it's going to be bullish. Okay. Yep. So with NVIDIA, this was a bearish put vertical. All right. So that is the current positions. Let's go take a look at what's going on with the markets and add a new position to this portfolio. And I think it's an interesting time for a discussion of the S&P 500. I wanted to just take a look at what's going on here with the S&P. And as we make a plan here, let's look out here maybe to add a new position out here in May. Since we already have a bunch of positions for April, let's add one for May. And so I want you to put yourselves in the shoes of a trader who's trying to plan a new trade for May. And the first question is, should it be bullish or bearish? And so as we're making that decision, here's what occurred to me this morning. I thought, I wonder what most traders would consider to be the most important element of a chart. Because I know what can feel most important, and that is whatever's happening at this very moment, right? Yeah, earlier today, markets were going down. Right now, the markets are going up. So guess what's going on with the emotions of a trader as they're trying to decide bullish or bearish? If their emphasis is on what's happening on that one day, it is a roller coaster ride. But when we're planning a short-term trade, as we're doing today, even though we're going out to May, that's still pretty short-term, right? For this vertical spread, and we are going to be doing vertical spread, there's a spoiler alert. Is it really most important what's happening today? Or is it maybe more important with where the S&P is likely to be on the 16th of May? Kevin says, May? I can't make a plan for tomorrow. Yeah, that's right. Greg says, how can we decide bullish or bearish? You're not sure? Well, it's always the best educated guess of the trader, right? Nobody has a perfect view into what the future holds. But I wanted to make the point that when planning these even shorter term trades, the trader can really get very much tunnel vision on what's happening right now, or even if they're able to push those blinders, I don't like that phrase, but if they're able to expand the horizon of their vision a little bit, they might even just look here and say, well, the markets are terrible right now. Well, I want to get maybe a longer term perspective than just what's happening today, or even just what's been happening over the last month. Let's go to a long-term chart and see if things change. How many of you find it helpful sometimes to take a step back, maybe back away from your screen a little bit, and see what's actually been happening over that longer term? And let me throw one other thing on here. Did anybody happen to notice this? There's kind of a trend line that's been moving through the S&P 500, not for the last day or the last week or the last month, but over the last about, 6 years? You can see that there's been an important area, potentially. Now, obviously, just because something appears to be the case on a chart, it's not a guarantee of what's going to happen next on the chart, but a number of touch points right around this apparent ramp on the S&P 500. And so for a trader who's been focusing on just what's been happening this morning is only 25% of this one weekly candle, which we can barely even see on this chart. Greg says, when you expand your history, shouldn't you go further out in time for your trade? That's a great question, Greg. And the answer is no, not necessarily. The trader could, but my point here is, do you suppose there are any would-be bearish technical traders that do a trade for the next 6 weeks or so, as we're planning to do? Let's roll forward 6 weeks, and let's make a big assumption and assume that we bounce off this trend line. And if we were able to grab those traders and say, wait a second, look what you may have missed on this longer term perspective. Could it have had an impact even on their shorter term decision? How many times has a trader got focused on maybe a short-term support level that they think is going to hold, and they miss on a longer-term time frame a potentially much more significant resistance level? Okay. Ravi says, can you please share the indicators for arrows up and down? Ravi, it's not an indicator. I drew them on there. I just used the arrow drawing tool right here. Okay. I literally drew in a line, and then I drew in each individual arrow, just to emphasize these touches along that trend line. Bottom line here is that for traders, even on the shorter term, they may want to just take a moment and get that longer term perspective and make sure that the two aren't apparently in conflict. It's just another technical observation. It may or may not add to the way the trader plans to move forward with the trade. But I think that longer term perspective can be important. So let's switch this back to our daily chart, and let's go plan for our new trade. But with this new perspective, maybe our trader is looking at, maybe they were thinking, wow, we have, in the near term, a sell-off with a rally. That to me, oops, didn't mean to zoom in. Let me zoom back out. Maybe our trader thinks, well, here's a high, and here's a high. Well, here's a low, and here's a low. Don't we have a lower high and a lower low? Could make that case. But from that longer term view, maybe all this lower high and lower low are doing is taking us back down to that long-term trend line. It could still change the outlook for our trader and change the way they make a plan for a trade that's even as short-term, in this case, as maybe 6 weeks. So let me right-click on, how much do I want to clean this up? Let me do this. Let me switch my drawing tool set back to the default, and that just cleans it off, gives us a nice clean chart. And let's go, I don't know if I want to do it that way. Let's go back to the S&P 500 long term. I'm just going to clean this up a little bit. Let me just remove some drawings here. Remove. I don't want to clear the whole drawing set because there are some things that I want to preserve on there. There we go. There we go. Sorry for the little bit of distraction. I just like a tidy drawing set. So let's just assume that our trader now thinks, well, it looks like we're more likely to head up than down on the evidence of the longer term view. Well, let's go have a look at a stock here. And I want to look at Amazon. So here's Amazon. Give me just your thoughts on this chart of Amazon. Some of you might be looking at this and say, well, let's see. So we've gone up for a while. We had an acceleration of an uptrend. Now it looks like we're trending down over the course of the last couple of months. Maybe lower high, lower low, bearish trade, right, Cameron? That's what you're going to do? Nope. I'm actually going to take a bullish trade here. Why in the world would I take a bullish trade on this for May 16th? Well, it may be that a trader has taken a look at that longer term perspective again. And let's switch up our drawing tools to let you see this through a different lens. Interesting. From the longer term perspective, yes, this 2-month sell-off has taken us down, but it's really come down to a previous area of resistance. If you look at this, over the course of about 3 years, Amazon really struggled to hold above that 190 level. There were a couple of weeks where we stayed above that level, but then we finally broke up and through, and it's like there was all sorts of enthusiasm with our traders. Oh, good, we're in new territory. Let's push things higher. And as we came back, maybe traders are reluctant to go back into some hard gained territory, right? Also, this has brought us back down to that longer term trend line in the upward slope. So is all of this longer term analysis a guarantee that come May 16th prices are going to be higher than they are right now? Of course not. But let's just say that our trader has taken a step back from the chart, gotten that wider view, and maybe they think that in this battle between short-term bearishness versus longer-term bullishness, maybe they think that it's more likely that the bulls are going to drive prices higher. So what we're going to do here is let's structure our trade down below this apparent previous resistance around the 190 that was also support for so long. And how about we do a long call vertical spread just below 190? So I'm going to do this. Let's buy a 180 call, and we're going to sell a 190 call. So let's draw in a line for pardon me, not the 180. We're going to buy the 185. So I'm going to make a green line right there for the option that we're going to buy. We're going to take that out to the May 16th expiration. And let's go to the trade tab. For 17th of April, we're going to close that up and go to the 16th of May and look at buying the 185 and 195. Just as a recap, if we're buying 185 call, it gives us the right to buy shares at 185, but then we're going to take on an obligation where we might have to sell those same shares for 190. Well, if we buy at 185 and we sell at 190, that'd be a $5 profit if those contracts are ultimately assigned and exercised. But this isn't a free trade. We're not going to make $5. It's going to cost us some money to set this up. How much might it cost? Let's see. It's going to be this one right here. Let's switch our spread from single. Let's go to vertical, and that's going to pair up the 185 with the 190. And it looks like that's going to cost us maybe somewhere between $355 and $390, maybe $370, $375. Let's click on the ask price to create that buy order. And let's say we're willing to spend, let's see, our mid is at 370, our natural is at 385. Let's say we're willing to spend 380. So if we're spending 380 to buy a vertical spread that can turn into $5, how much reward is there left in that trade? 380 invested to try to turn this into a $5 value. That's $1.20 of potential reward. So we also have to be aware of the risk. If we're spending 380, we can lose 380 on that vertical as a maximum theoretical loss. So one contract would be $380 of risk. We've typically been keeping our risk at about $4,000. Let's dial this up and do 10 contracts. There we go. And John, let's see. SPX looks like Amazon. There were definitely some technical similarities between both of these charts, weren't there? Yeah. Well, let's click confirm and send here. Going to buy 10 of these Amazon 16th of May 185 190 call verticals. Going to try to spend 380 for those. That would be a $3,800 investment with a $1,200 maximum profit. Yes, there's more that we can lose on this trade than we can gain because it's a high probability trade. That's the way options work in almost all scenarios. I have to say almost all because in my experience, it's pretty much all, but I always have to allow for the potential for exceptions. In any case, $13 commission to be paid here. That can increase the cost of the trade a bit. It can reduce the reward potential of the trade a little bit. But let's send this off and see if we can get filled for 380. Let's go back to our monitor. There's our order. Yeah, we were offering a 380. I just noticed it was about 367. So we just filled at 370. So that leaves about $1.30. So let's go look at our chart. What do we want from this trade from here? Well, just to map this out again, we have the 185 long calls here. And then we sold, I don't want to necessarily, well, let's do this. Trying to decide what I want to do with this line. I'm just going to draw another line. That's okay. I'm going to draw it just slightly below this one so we can see it. Where can I put that? Right about 190. That's okay. I'll just put it right on top. Who cares? Let's carry this through to expiration. That's my short option. I'm going to right click and edit the properties of that second trend line. So that's our short option that we sold. And we'll put in a text note right here. We have the 190 short calls. So our preference here is for our stock to be above 190 as we get toward that May 16th expiration. Do you notice where it is right now? It is well above where we need it to be. We need the stock to be up here, anywhere up here. Where we'd not like it to be is down below, and I'll go and adjust these boxes afterward, but our break even is going to be a little bit below our short call strike. Let's make this, for now, make this our red zone. We don't want to go down here. We want our maximum gain. There we go. All right, so there's our trade. Milan says, Amazon, what happens if stock goes down and the short leg is in big profit? Cost of the spread is 390 and profit is more than 390. So Milan, this is a bullish strategy. If the stock goes down, we'd be in our max loss scenario. Let's talk through this. If the stock, let's say it fell down to 180. Well, we have the right to buy shares at 185 that are only worth 180. Are we going to do that? No. Wouldn't make any sense. Someone else has the right to buy stock from us for 190, and the shares are only worth 180. Do they have a strong motivation to overpay us by $10 per share? Nope. So everybody theoretically just walks away from this deal. Well, that's not good because we paid $3.80 to get into this deal. That's our exposure to risk. We could lose the $3.80. So along the way, if it starts to misbehave, if the stock is going down instead of up, and especially if it starts to come down below 190, what might the trader consider doing before that May 16th expiration? They might want to think about getting out for what they can get out for. It's probably not going to be 380. It's probably going to be less than that. So there's going to be some damage that might be taken. But yeah, that's a good question, Milan. If it goes down here below 190, if it goes below 180 or 185, that's where we're in the worst danger for maximum loss. Okay, if we wind up in between the strikes, let's say we're at 187, and let's say we get all the way to expiration, we're at 187. Well, we have the right to buy shares at 185. Are we going to do that? That contract would automatically be assigned on our behalf, and we buy 1,000 shares of Amazon at $185 per share. I'm sorry, can you do the math on that? It's $185,000. Yep, that would automatically be exercised on our behalf. The short option would be out of the money, and with rare exceptions, that one would just expire worthless. So if we're in between our strikes, the trader probably wants to get out before expiration unless they really wanted to spend $185,000. John says, thoughts on closing single legs of verticals? We sometimes do that. John, we'll talk about that in future webcasts. It would take us beyond our allotted time today, but it's a good question. Milan says, can I not just sell the short leg? Well, sell, it said, I think you mean buy to get out of it, or you mean exit? Get the profit over total debit and let the long leg ride. That's a possibility. I think, yeah, so if we happen to dip below 190, maybe the trader can buy the short call back for less than they originally received on it as a credit. And then if the stock starts to rally again, could that open up a new window of larger opportunity? It could, but it also reduces the probability of the trade overall, because owning a long option is a low probability proposition just by the inherent math of the situation, because of time decay and because of the spread between the bid and the ask. The combination of those two factors creates a low probability scenario. Okay? In any case, guys, we have accomplished what I set out to do today. We'll see how this trade goes. We're well up here where we need to be. So as long as the stock doesn't sag back too far, if it decides to go down, as long as it doesn't go down too far, we're in good position for maximum theoretical gain on this trade. Time will tell. We'll see. But we have managed our existing positions. We took a look at the markets, and we talked about getting a longer-term perspective on things, even for shorter-term trades. And then we went ahead and placed a shorter-term trade. So I think that's a good discussion. Guys, time for me to let you go. Go enjoy the rest of our educational webcast today. But as you do, remember, take a couple of steps as a benefit to yourself. Number one, make sure that you're subscribed to our Trader Talks channel. You can go down below the video stream right now and click on the subscribe button. It doesn't cost anything. It only takes a second. But our Trader Talks YouTube channel is where we house our playlist for previous webcasts. And you can also join our live streams here. Also, make sure that you're following Connie and me on X. You can find Connie at Connie Hill CS. You can find me on X at Cameron May CS. There's my handle on X, but it's the best place to connect with your favorite presenters in between these live streams. Hey, everybody, thank you for the 36 people have already clicked the like button. That's very much appreciated. If you like one of our webcasts, make sure you click that thumbs up. It's applause to your presenter, and it also gives my webcast a boost in the YouTube algorithm that it just helps more people find these webcasts, and more people can learn. All right? Okay, everybody, Go have a great day. I will see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.